In 2025, the world of investing is changing faster than ever before. Did you know that over 90% of retail investors fail to beat the market in the long run? Shocking, right? Despite all the information and tools available, most investors still make the same mistakes over and over. But here's the twist: value investing is still the secret weapon that the pros use to build long-term wealth. You've probably heard of famous investors like Warren Buffett and Charlie Munger. But did you know that the average return of value investing over the last 90 years has outpaced growth investing by more than 2% annually? That small difference adds up to millions of dollars over time. In this video, I'm going to show you 6 critical skills that will take your value investing game to the next level in 2025. These aren't the usual tips you've heard 100 times. No, buy low, sell high, clichés here. We'll dive into how to use AI, how to master patience in a world of instant gratification, and why understanding behavioral economics could be your edge in the market. Stay tuned, because by the end of this video, you'll have the tools to spot undervalued gems and navigate any market with confidence. Get ready to become the investor that others envy. Chapter 1. The Invisible Edge: Identifying Undervalued Stocks in Plain Sight. In a world flooded with financial news and stock analysts, finding undervalued stocks can seem like a daunting task. The secret to discovering these diamonds in the rough lies in looking beyond conventional metrics. Many investors only focus on the usual suspects: earnings, P/E ratios, and debt levels. But there's much more beneath the surface. One of the strategies is to explore underappreciated sectors. For example, while tech stocks often steal the limelight, areas like infrastructure, agriculture, or niche healthcare often fly under the radar. Take agricultural stocks in emerging markets, which have grown by over 8% annually for the last decade, compared to the S&P 500 7%. Another tactic is searching for companies with long histories of profitability but temporarily depressed stock prices due to external factors like economic cycles or market sentiment. Warren Buffett once said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This quote holds weight today more than ever. A deep dive into overlooked industries or untapped markets can lead to opportunities most investors miss. Think about how companies like Costco or Home Depot, once undervalued by the market, became massive wealth generators for those who invested when others ignored them. Chapter 2. Data is the new gold. Mastering AI and machine learning for value investing. Artificial intelligence, AI, isn't just for tech enthusiasts anymore. It's changing how we look at value investing. In 2025, learning how to integrate AI tools into your analysis can significantly improve your decision-making. AI can help you analyze data in real time, uncover hidden trends, and predict future movements with higher accuracy. The machine learning model, known as predictive analytics, uses historical data to forecast a stock's potential performance. For example, by studying past earnings reports, sentiment analysis from news outlets, and social media chatter, AI can highlight stocks that are likely to see growth. According to a report by McKinsey, companies that use AI in investment strategies have a 20% higher success rate in predicting stock price movements. But here's where it gets really exciting: AI isn't just about faster data processing. It's about deeper insights. Instead of relying solely on human analysis, AI can comb through millions of data points, instantly highlighting undervalued stocks that might fly under your radar. As investor sentiment shifts, AI allows you to pivot faster than ever before. Think of it as your personal assistant working 24/7, constantly sifting through the noise. Chapter 3. The Power of Patience. Timing your value plays for maximum impact. One of the core principles of value investing is patience. Yet, many investors are driven by short-term gains, which often leads to mistakes. In fact, a study by the CFA Institute revealed that the average investor holds a stock for only 5.5 years, far below the recommended 7-10 years for value investing. To truly excel, value investors need to understand market cycles and not react emotionally to short-term volatility. During market dips, value investors have the chance to buy stocks at a discounted price, if they remain calm. Historically, the stock market has always rebounded, and in the long run, the patient investor comes out ahead. Take, for example, the 2008 financial crisis. Investors who maintained their positions in blue-chip stocks like Coca-Cola and Johnson & Johnson saw their investments soar by more than 200% in the years following the crash. In the short term, the market is a voting machine, but in the long term, it's a weighing machine, Benjamin Graham famously said. If you're playing the long game, patience is key. Subscribe for more value investing strategies that will help you stay ahead of the game. Chapter 4. Mastering Behavioral Economics. Avoiding emotional traps in value investing. Our emotions can often cloud our judgment, and this is especially true when it comes to investing. Behavioral economics explores how psychological factors can impact financial decisions. The key to becoming a successful value investor in 2025 is to understand these emotional traps and avoid falling into them. Fear and greed are two of the biggest culprits. When stocks drop, fear may lead you to sell at the wrong time. On the other hand, when prices are rising, the greed to make a quick profit may encourage you to chase a stock that is already overpriced. According to Nobel laureate Richard Thaler, investors often make irrational decisions based on emotions, and these decisions often lead to significant losses. To overcome these biases, value investors need to develop discipline. A useful strategy is to set clear buying and selling thresholds before you ever make an investment. This takes the emotion out of decision-making. For example, if you believe a stock is undervalued at $100 per share, stick to that belief and avoid the temptation to sell when the price dips below that threshold. Over time, this approach leads to fewer emotional decisions and more rational investments. Chapter 5. The Dividend Detective. Finding sustainable passive income through value stock. Dividend stocks are one of the best ways to build a steady stream of passive income. But in 2025, it's important to focus on finding stocks that not only offer high yields but also have the ability to sustain those payouts over the long term. Look for companies with a track record of increasing their dividends year after year. According to research from Ned Davis Research, companies that consistently raise their dividends outperform those that don't by 3–4% annually. A great example is PepsiCo, which has increased its dividend for over 50 years. This kind of reliability is crucial for building a passive income portfolio that can withstand market fluctuations. Investors should also consider dividend growth rates. A high dividend yield is attractive, but if a company isn't growing its earnings, that yield could eventually become unsustainable. The key is to look for companies with strong fundamentals, low debt, and consistent revenue growth, traits that not only support dividends but also ensure long-term profitability. Chapter 6. Crisis-proof investing. How to thrive in uncertain markets. The world is full of uncertainty, whether it's geopolitical events, pandemics, or economic slowdowns. But history has shown that the most successful investors are those who thrive in uncertain times. In fact, many of the world's greatest fortunes were built during times of crisis. In 2025, mastering how to find opportunities during market downturns is crucial. When others panic, value investors see it as a chance to buy quality companies at discounted prices. For example, during the COVID-19 market crash in 2020, many of the world's top investors, including Buffett, used the opportunity to buy undervalued stocks in sectors like healthcare and consumer goods. To thrive during uncertain times, focus on companies with a competitive edge, those that can weather the storm and bounce back. Coca-Cola, for example, saw its stock price plummet during the 2008 financial crisis but rebounded strong because of its dominant market position and brand loyalty. As investor Ray Dalio says, the biggest mistake you can make is to be in a position where you are vulnerable to a big loss. Don't forget to subscribe for more tips on building a crisis-proof investment strategy that will keep you ahead, no matter what happens. In conclusion, value investing in 2025 requires more than just knowing the basics. It's about using modern tools, understanding the psychology behind decisions, and staying disciplined in the face of uncertainty. By mastering these 6 skills, you'll be well on your way to becoming a savvy value investor in the years ahead.